Hey everybody, hey traders, Chris Pulver here with Jared Johnson from Beyond Capital Group, and hot off the press, we have CPI data this week from the US, and man, have they changed things. Now, the whole world has been speculating, where are the markets going? Are we going back into a bull market? Is it all bearish all the way? So rather than speculating, Jared and I are going to look at the real numbers with the Bank of America Fund Manager Survey. All that and more in today's video from the Beyond Capital Group.
Okay, traders, we're going to dive in. Got Chris Pulver here. Good to see you guys today. Afternoon, evening. We've got some good stuff to chat about. We've seen quite a bit of action in the market lately. We see this big optimism. We see lots of ups, and then we see lots of fear and lots of downs. And there's a sense, at least I'm getting a sense, that nobody really knows what to do, right? And so we're going to talk a little bit today about what the big money is doing.
Right. No more speculating, Jared. We have the numbers in. The Bank of America Fund Manager Survey came out. And by the way, this is hot off the press with CPI data this week, which was all eyes on CPI data, all eyes on the Fed. And we've got some slides to show, so let's jump into that. But let's start with that Bank of America Fund Manager Survey.
Let's pull this up. Now, for anybody that's not familiar with what the Bank of America Fund Manager Survey is, this is where Bank of America and all their great research folk, they survey typically around 200 to 300 fund managers. And we're not talking like some financial planners that are like, how can we get you 1% a year? They're talking about the folk. So these 200 to 300 people manage usually $600 to $800 billion. So this is a significant amount of the money that is being managed in the market right now. So we're going to have a little peek at that. And here's some interesting numbers. We're going to pull this up right now. We've got some wild things. Now, some of these charts are crazy to look at, so we're just going to kind of walk through them here. Now, that top, biggest, bluest bar is telling us that the biggest position is where, Chris?
Cash.
In those dollar bills.
Cash is king right now. Cash is king with the uncertainty right now.
Cash is king. Ray Dalio is infamous for saying cash is trash.
Right.
But stocks have been kind of trash lately too. So you got to kind of pick your positioning here. And it looks like the fund managers are picking huge cash positions. In fact, that's the biggest position.
And I think that also goes in line with preservation of capital, right? I mean, a lot of overweight exposed hedge funds were getting hit really hard in April and June with those big slides. When everything was red, I think there's a lot of exposure that fund managers needed to tighten up. And so now this shows us that heavy cash is, Jared, look, a lot of this cash needs to be allocated, wants to be allocated. One thing we also identified is this is one of the heaviest buildups of cash we've seen since 2000, and also one of the least amount of allocations. So we have tons of cash on the sidelines waiting to be deployed and relevered, but we also have very little allocation because nobody really knows what direction to trade. So heavy cash, and notice the next one, staples. Consumer defensives, right? The more the value stocks, the dividend stocks, the low beta stocks. Those are your two biggest positions on where things are at right now as you kind of ride out the uncertainty. And I will say this, I think a lot of the uncertainty was, reiterated this week with the Fed and the CPI on Tuesday, because the expectations once again shifted. The target is shifted. We'll talk about that in a little bit with the CPI data and the CME FedWatch tool. And you want to take the red boxes on the bottom? Where are these fund managers not sitting?
These guys are super light equities, and nobody wants to touch Europe. Now, we've talked in previous videos about the fact that Bridgewater, our good buddy Ray Dalio, they had huge short positions in Europe, right? So they were on the opposite side. They were saying, yeah, we're going to have major exposure on the short side in Europe, and that did well for them. And nobody really wants to be heavy in just the equities of that side of things. European equities are so scary. Fund managers are just kind of staying out of that whole entire space. There's a lot of what's going on. Where are we supposed to be going? Let's get out of the stock market. Let's stay away from Europe. Let's just sit in heavy cash, and let's put our money in, Procter and Gamble, right? And that's kind of where these guys are positioned. Now, the interesting thing that goes along with this is we see the extremes, right? Heavy cash positions, next to nothing in equities, right? So we've got these two extremes here. If we move on and we have a little look at this, look at I thought this chart was so interesting, right? Because
Mhm.
what we can see here is some of these crazy examples of extreme positions where fund managers thought that profits were either going to get worse or at least not going to get better, right? And we're in a situation right now where fund managers think global profits will improve. And as you can see on this chart, at least taking us back to the kind of mid to late 90s, we're at the lowest point, right? We're below COVID. People were more
And below
optimistic that
2008.
yes, yeah, people were more optimistic when there was a pandemic. They were more optimistic when the housing market, the safest investment out there, was falling apart. They were more optimistic about global profits improving than they are right now. Now,
Crazy.
I think we need to bring up extremes, right?
Hmm.
Extremes are typically, well, I don't know. What do you think about when you see an extreme on any chart, any statistic, any data? What's the first thing that comes to your mind?
Exploit it. I mean, an extreme is. I mean, look, it's going to be like a rubber band, right? It stretches only so far before it comes back, and so there's the reversion to the mean. There's extreme levels to buy low. There's extreme levels to sell high. In this case, I mean, we're looking at it from a bullish standpoint of if things are on sale, let's do everything we can to buy it as cheaply as possible and continue to lower our cost basis.
That's
So
right.
I think that if we have the cash to deploy, I want to deploy it, but it's just not all at once. I mean, I think you could go back to the old school method of dollar cost averaging. You could have some little chunks and little nibbles here and there to just be, diversified but lighter exposure, so it's not heavy positioning. I mean, the
I
good thing is cash is working capital. I mean, if you're going to deploy it, it's going to find its way in the market. It's not like we're trading illiquid markets right now. It's just big money is just waiting for a little bit more of a green light. It's waiting for more of like the coast is clear. And if things are going to get worse, they have to be positioned to take it, because rather than getting punched in the mouth again, like we saw back in April and June, I think it's more like, okay, we can absorb the next potential leg lower and then have lots of cash to buy into that. Right. And I think a position like this looks like an extreme where there's just going to be so much opportunity. It's just when. Is it Q4? Is it Q1 of next year? It's just at some point this pendulum shifts and that rubber band will snap back and we'll have some amazing opportunities in recoveries.
Yep, absolutely. And that's, the fund managers are showing us the same thing. They're saying, well, we're sitting in cash too because we all want to wait. Now, a benefit of sitting in cash, a benefit of having, some of the biggest money in the market in cash right now, the biggest exposure, these huge fund managers, is that when stocks have just been sold to death, it does limit the downside to stocks, right? If everybody's already out, it's not like we can have another big route of selling.
True.
It's kind of happened, right? Doesn't
True.
mean stocks won't go lower or can't go lower. They certainly can, but this kind of, I think, takes away a little bit of that crashiness and just kind of, because everybody's sitting on the sideline, a lot of big money sitting on the sideline. So it kind of calms the
Yeah, that's a
storm
good
just
point.
a
You
little
won't
bit.
have like the black box effect, right? Where it's like just triggering sells and sells and sells and exploiting those moves even further. Yeah, that's a
Exactly.
good
Like
point.
like we saw with Netflix and Facebook, we saw their stock, from an earnings drop 30, 40,
Right.
50% in
Right.
one single earnings. I think
Yep.
that stuff is over. It doesn't mean these can't trickle a little bit lower, but the big
Hmm.
selling I think is out of the way because people are
Agree.
now just in cash.
Yeah, the heavy
So
deleveraging is gone.
yes, the major deleveraging is
Mhm.
is is out of the way. Now, this chart, I love this chart right here. This talks a little bit about the growth pessimism. So we're going back to 2008. These fund managers, first of all, are getting super underweight equities. Number
Mhm.
one. Number two, the pessimism, which is always a great one to
The
say,
pessimism.
pessimism, is just at once again extremes, right? We see major extremes over here. So we go back to 2008, and we're right back at those levels of
Yep.
just doom and gloom.
But look at that chart and see, okay, so 2008, once we have finally established a low, look at what followed from 2009 to 2010. That is a very aggressive move right back up to highs, right? So you go from extreme pessimism to the coast is clear, plenty of opportunity. There's a recovery, and all of a sudden you're talking about bull markets confirmations. You're talking about the growth is here, the bull market's back. I mean, that's 08 to 09, which was arguably the worst financial crisis we've ever seen, and financial Armageddon. And I know that there's a lot of arguments with, is this year going to be worse? Is 2022, can it possibly be worse than 2008? I mean, from a sentiment side, it seems like it's trying to be, but from an actual fundamental side, you and I have had a lot of conversations on it isn't really the same, but again, it doesn't have to be the same to still be terribly pessimistic out there. But it's crazy.
Well,
Like we're only 25-30% off the highs, and we're treating it like, we've lost 80% of the value or 60% of the value of the entire market.
and here we go, we're all the way, a decade plus, creeping up on a decade and a half past 2008.
Mm-hmm.
And now it's so distant in our memory that we forgot what it feels like to be panicked about the market.
Right.
And so as this has happened, 2008's far enough back there, and we're going, this is way worse than 2008, right?
Mm-hmm.
Because we don't remember 2008. We statistically remember it. We remember the chart, but we don't remember how the overwhelming prevailing feeling in America and the world was. And
Right.
so to say that, there's a lot of access to information, there's social media, there's everything. I think it's in people's faces a lot more. And I think there's such a bigger reaction now. And we've talked about this, right? We're seeing huge moves up and down. We're seeing huge reactions happen much more quickly than they did 10, 15 years ago. So
Sure. Yeah, volatility is definitely elevated. We've seen that for the last couple of years, and
it's
I
quick.
mean,
It's scooting, man.
It is. I mean, we've had conversations where it feels more like speed chess, where like these rotations in and out, and I mean, it can happen in months as opposed to years, and so that is definitely a big adjustment for what you're used to seeing traditionally in some of these big swings.
And everything's always the same, but that doesn't mean that the speed and the processing of it has to go the same as it did before, right?
Mm-hmm.
It's always the same process. There's panic, there's taking in the data, there's overreacting. It's just these things are happening. I mean, we've all watched a YouTube video at 2x speed, right? Where people sound like chickmunks. That's kind of what all the time.
Yeah.
So that's kind of what's happening in this market, right? Everything is just at record speeds.
Mm-hmm.
So this is one of the last slides regarding that I think you and I found the most interesting in the fund manager survey. But this is just hedge fund exposure, right? Equity
Mm-hmm.
exposure. And again, we're creeping up on this right here. We're back to record lows. We're back to pandemic levels. We're creeping back to 2008 levels, where nobody wants to buy anything, nobody wants to own anything, which always to me has me on high alert that re-leveraging has to be around the corner, even though it might not be yet.
Yes.
But this is a great opportunity to. I mean, let's just go back to my my old neighbor Warren Buffett. Warren Buffett says when everybody's fearful and nobody wants to buy anything is when we should be buying. And so
Right.
this is a great opportunity for this. So we've got some crazy things happening. We're going to talk about interest rates in a second here, but I mean, this is quite an opportunity for us to start getting cautiously bullish. I feel like I'm totally in the cautiously bullish camp. Where do you find yourself?
I'm right there too, and that's been my two favorite words for the last 2 years. It's felt like since 2020's recovery, it's like cautiously bullish, and planning on some corrections in 2021. We never really had them, and then all of a sudden tech started to correct. That snowballed into 2022. Everything started to correct in 2022, and so now we look at the charts. We know that right now the big theme in the market is CPI and everything that goes along in inflation. It's not just CPI, right? I mean, yes, that was the big data this week, but it's not just CPI. There's more to it. There's the ISM, there's PCE, all these acronyms and stuff. But the Fed and these central banks, right now they are tightening, and that is changing the market. That's changing the market expectations. So I know we're going to talk about that very briefly for the CME Fed Watch tool, but we could just, it just happened right in front of our faces this week. And so to take the fund manager survey and take the data for what the market had priced in and expected, it has now shifted. And if you bring up the slide, Jared, I took a screenshot of it in my trading room this week on Monday, and the expectation was that the Fed funds rate by December of this year would be at 3.75 to 4%. That was the highest point, and it would stay that way through July of next year. Literally, with the CPI data that came out on Tuesday, it is shifted forward to now the market is expecting the Fed to be at 4.25% to 4.5% potentially by the end of the year, and staying that way all the way through 2023. So there has been a 25 to 50 basis point shift in more tightening, more hawkishness from the Fed. Now, I think what a lot of these fund managers are waiting for is the Fed to officially pause, right? And this pause doesn't mean the Fed has to start cutting rates. It means that they're going to stop telling the market about raising rates. And all
That's
these other
right.
central banks that are raising rates will also be looking to pause. And I think that is what possibly that cash and releveraging is waiting for. And again, cautiously bullish is a perfect way to put it, because we will be positioned for whatever happens. And I think anybody to take away from this video, if the market goes down another 20%, we just read an article this morning from Ray Dalio. If the Fed funds rate's at 4.5%, he predicts another, just by math, another 20% down in equities. So if that is true and the market goes down another 20%, what does your portfolio look like? Are you positioned to absorb that? Are you positioned to profit from that? And then the other thing is let's say there's a line in the sand and it doesn't really go down any further than it already has, and we stabilize and we still don't have fresh lows from June, and we make a higher high and we break above and we're back to the highs of the year. What does that do to your portfolio? So what we're doing is we're cautiously bullish because we'd be preferring to hold long positions, right? As far as like long-term growth. But we also need to know that if the market dips and drops, we need to be braced for that and absorb that and be ready to buy stuff on sale. So
Absolutely. And remember, guys, we want to, the whole purpose of this YouTube channel here is to just help people navigate what we're seeing, right? And so we're just sharing our ideas, we're sharing our thoughts. But remember, just recently, just a few days ago, we posted a video on an SPY position that we put some exposure on, because we thought, look, if this thing's gonna show a little more pain, how can we make some money on that? So we'll link that video in the description below, just to make sure you guys have a chance to review that one. But we talk about some trades that we've done, some bearish trades on the SPY, on the S&P. So that's a great time for that. So thank you for watching, everybody. Keep an eye on things. Please like and subscribe to our videos and our channel. We're going to continue to share with you guys the latest up-to-date information. Hopefully you found it interesting and helpful to see what hundreds of billions of dollars are doing and how they're positioned, and likewise, how we're positioned. So thanks for watching. Chris, thank you, my friend.
by the way, Jared, you look very sharp today.
We gotta mix and match a little bit. T-shirt.
I know. Yang and yang. We got it.
We got it. Thanks, everybody. Take care. We'll see you guys soon.